Good afternoon, everyone. Something that I learned from Barack Obama in one of his speeches. Okay, how to get the audience out of the slumber. Okay, I know we are standing between you and the lunch, but as rightly pointed out by the announcer, that this is going to be immense food for thought for the private credit industry, as far as Indian ecosystem is going on. Now, let's rewind the clocks a little bit, say a decade back. Banks and NBFCs were the main source of funding. So private credit essentially was a part of, what banks could not do or what banks cannot do. That's where private credit used to come in. Now from that we have evolved to, a full spectrum, I would say, where, we are here from performing credit to opportunistic and special situation distress fund financing as well. And my compliments to the IVC team for putting together such a good, such a, I would say, expert panel, okay, who would represent each and every section of the spectrum that we are talking about, from one end to the other. Think of a jungle, think of a forest. There are large carnivores, small carnivores, there are small herbivores, big herbivores, there are reptiles, there are birds, there are insects. But everybody put together keeps the jungle alive and thrive. And we all represent a different section of that particular spectrum here, okay? I have come here with my notes, and I will be taking notes because you don't get to get this kind of a gathering every day. The questions that I will be asking to them, and I'm sure when I say this, I am talking on behalf of the audience here, that where is the money flowing as far as private credit is concerned? Okay, is the market pricing the risks properly in each and every segment of yours? And are the boundaries blurring? For example, are you stepping on each other's toes? For example, performing credit is stepping into an opportunistic credit, something, and where do we go from here? Based on last 5 years and the current scenario, where are we looking to go in the next 5 years? Okay. So with that, all the panelists, they need no introduction, but just for the benefit of the audience over here, if you can just pick up the mic and tell that which particular segment you are in, okay, in the performing credit spectrum, in the private credit spectrum, and why you chose to be there, very briefly. I will start with Anshul.
Hi. So, no, thank you so much, and I think your introduction was very flattering. So we actually call ourselves within the entire spectrum to be placed in the high yield performing credit. Usually from a range perspective, we're targeting between 15 to 18%. From a products standpoint, of course, we're doing performing, so we do not really touching on the special situation side bit, and also we're not really doing anything which is early stage of venture. So that's where exactly I would call myself to be placed as a strategy.
I am from Stride. So Stride invests in growth in late stage companies. Essentially for us, it's early growth and late stage. The only differentiation is that the companies necessarily have to be VC or PE backed, so sponsor led companies. But most of our deployment is also growth in late stage, although number of deals wise, there could be many early stage names also. In terms of return perspective, it would be similar, say 16 to 18%, which is the net return post fees and expenses.
Hi, this is Ashutosh. I represent Neo Asset Management. Neo Asset Management has a multitude of strategies, largely domestic. But having said that, we have private credit. Within private credit, we have special situations as well as performing credit. So in fact, the challenge is even more starker for us because the spectrum of credit is very diffuse. So where does performing credit's boundaries stop and special sets begins? And we shouldn't intrude in each other's category. But having said that, so far, because performing credit is a very diffuse term, as you rightly said, there are companies which are making money, they are profitable, sometimes they are unprofitable, sometimes VC, funded, sometimes promoter who has been running a business for last 50, 60 years everything to my mind, anything where we don't see signs of stress, where we see phenomenal financial flexibility, where we can sleep at night, and like we say in jest, that where we don't have to do any risk review, is basically performing credit to our mind. So,
thank you, Ashutosh. Hi, I'm Ashish Khandelia, representing Certus Capital here. So our primary business is actually real estate private credit, which forms almost 40% of the overall private credit allocations in India right now. So the real estate private credit actually runs a little bit differently because the industry has a very large need, but the financial institution can only service a certain value chain of that. So we typically look at credit spectrum, the return spectrum of anywhere between 16 to 22%, focusing a lot on performing real estate projects and sponsors, and also special situations. And I would really differentiate distressed from special situations, which I can elaborate a little bit more. But effectively, where the underlying we don't see any problem or stress with, but either the situation allows us to make a higher return, or we are filling a gap that the traditional institutions cannot.
Hello. Hi, I'm Gurudat from Multiples. Firstly, thank you IVCA for having me here, and thank you Shubha for that question. For us, Multiples private credit strategy would basically fall at the center of the spectrum. Shubha, going by the lexicon that you've constructed, we see, we as an institution, we have the capability to mobilize large pools of capital, and at the same time we'll play to our strength, which is deep-rooted investor relationships on one side and strong corporate relationships on the other side. So basically private credit, I think, is the best suited platform to seamlessly bring all these elements and get them to some sort of a meaningful convergence. We see ourselves originating and investing in larger deals for a significant part of the portfolio, and the rest would typically be mid-market in nature. So basis this construct, and to this end, we will operate at the conservative side of risk return. And that is how we're going to play this, whereas we will expect that the mid-market part of our portfolio generates the alpha that we desire for the fund. So that's broadly the strategy that we want to follow.
Thanks everyone. So ladies and gentlemen, that's the jungle out there for you. Now we heard the tigers, we heard the leopards, we heard the bears, we heard the wolves. Okay, not going into literally into their hunting methodology or survival and thriving methodology. Okay, each serves a purpose. Okay, now we have the entire spectrum covered over here. We have Ashutosh from performing credit. Okay, then Apurva, who's into venture debt, and which is adjacent to performing credit, but a little more, maybe you can call it risky, or you can call it a little more dynamic. Okay, Ashutosh, please don't take offense. Okay. And then we have Gurudat, and we have Anshul, who are kind of competing in the this mid spectrum or structured kind of lending. And then we have Ashish, who is into performing real estate, but also dwell into financing of distressed assets acquisition, special situations as we call it. Okay. So the entire spectrum, we would like each and every one to speak about their particular section of the spectrum. Okay. So I would like to start with Ashutosh. Okay. So performing credit in India has compressed trust spreads significantly. Okay. The entire idea of capital chasing to various I would say prospective borrowers. Okay, now do you find it challenging? Okay, because with more and more banks chasing the same kind of people that you are chasing. Okay, and sometimes the capital where the money is fungible, the color is fungible. Okay, so do you face those challenges as a private credit operator in the banking system and chasing the companies who are doing well in terms of performing credit?
So the way I would like to think about it, I have my kid, he is 10 years old, and every now and then he would ask this question: have I grown up? Now can I go to school alone? Private credit as an industry is a 5-year-old industry. India as a corporate credit market is 160 lakh crore. In that 160 lakh crores, total industry size, I mean, the Brookfield guys presented a while back, is around maybe 2.5 lakh crores. And within that also corporate credit, non-RE credit is less than 1 lakh crore, which is again split over, so many players. When we look at so basically the industry size is too small so far to worry about the fact that is there so much competition. We are too young, we're too small, we don't need to worry about it. Secondly, when we look at our pipeline, when we look at our borrower behavior, so every 10-20 days, as a team, when we discuss things, we figure out that our trades are changing all the time. Had there been so much of a crisis, we wouldn't be finding trades. But that's not the case. We've been comfortable on that front. And most of us, when we talk to promoters, I'll give an example. When we go for a housing loan, typically the behavior which we observe is that somebody offering me 7.9 and a federal bank comes and says 7.7, and that's it. The trade is off, and we'll go to the second guy. But when it comes to our deals which we are running, we typically get a promoter in, we give him some promises, some certainty, some assurances that yes, this will get done. He judges us. We judge the promoter, counterparty, that whether this trade is doable, and he also judges us that whether these guys will deliver, whether they have the capital, whether they have the appetite, whether they have done something like this before. Do they understand my business? Are they taking me for a ride? Will this diligence go for waste? So when both the parties are investing so much into something, competition actually is left behind. And at that point, all that matters is whether the deal makes sense for both the parties. And honestly, 50, 100 bips for a promoter, and all the trades that we do actually are opportunistic in nature. Nobody comes to a performing credit fund, any of us, to take money for 5 years. Most of our money is concentrated for 1 year, 1.5 years, for solving a very specific problem. That problem is gone, and our borrowing is also gone. So for something like that, to be able to pay slightly higher for 1 year, it's not really the competition which we are worried about. As I think somebody mentioned a while back earlier, that now banks are also coming in, to some extent. And by the way, in a lot of our trades, we have seen that, banks have actually underpriced us. Even when the regulations were not supportive, even then that has happened. But having said that, largely speaking, what we feel is our job as managers is to generate a sufficiently deep pipeline, run a large set of situations, and conversion will take care of itself. That's the way we think about it. So far, I think competition has not been so much of an issue for us.
Interesting. So an extension to my previous question, this is about competition with the other, loan providers or finance providers as it is. What happens in a falling interest rate kind of a scenario?
So when we go and meet our, especially our, ultra HNI investors and distributors, one of the most common questions is, interest rates are going to fall. I don't know why they feel so strongly about it, because every now and then events happen, right? War happened, interest rates suddenly rose by 40, 50 bips. Now the US rates are way too close to Indian rates. So I think RBI's pace is limited. Given all those things, suppose if interest rates fall also, the way we feel is that that end of the spectrum, basically the AAA, the AA, the sovereign, actually moves in sync. So tomorrow if, 10-year GSEC falls by 50 bips, a AAA corporate will price it in minutes. We're not even talking about days, it'll reprice in minutes. When it comes to, A-rated corporates, bank credit, it'll maybe price in maybe a week or a month's time. But who are our borrowers? Our borrowers are not being able to approach a mutual fund. Our borrowers are not going to a bank, because anyways it's a non-bankable situation. And sometimes, not me as a performing credit, but there are various shades of private credit which lend to people who actually can't go to either a bank or an NBFC for various reasons. In those kind of situations, when they don't have access to a competing pool of capital jiska price gir raha hai, why do I need to worry about that? So the transmission from a sovereign or a AAA to a BBB borrower is actually very low, and therefore we don't feel that falling interest rate scenario is going to be an issue at all. That's the first thing. Secondly, most of the private credit, at least that's what our philosophy is. That maybe I wouldn't hazard a guess for others, but our philosophy has been to focus on shorter tenor trades. 1 or 2 year is our sweet spot. Maybe give money to people for 1.5 years, 2 years. So we anyways don't run duration in our portfolio. So whether interest rates rise, whether they fall, it's not so much of an issue for us. What we care about is the level of interest rates at which we lend, and very quickly, you know, they keep on going. So I think interest rates as a factor is not very material for the performing credit segment as such.
Well, that answers the financial part of that. Okay.
Hello. No, I'm just adding to what Ashutosh said. See, we have been operating in this particular fund category for last almost 10 years, right? This is our third fund. We've delivered and exited fund 1, fund 2, and this is our fund 3. Now in all those funds, between these 10 years, there have been cycles of interest rate, right? We have gone up, we have gone down from a repo standpoint, etc. But if you look at the fund performance, it is absolutely in the same bucketed strategy, right? What does it mean? One is we are not correlated to what's happening in the interest rate cycle. And this is one of the biggest factor I feel. Now LPs are also seeing that, and that is why this strategy, when we offer them as a diversification, is really working. Because across this, not just the interest rate cycles, but the equity cycles have also moved. Yeah. But what your return that you have delivered across 10 years in 3 different funds is absolutely being the same, is the highlight that now people are noticing. So I agree with him that there is hardly any correlation in terms of the interest rate cycles and also with the equity cycles now.
Let's come to the non-financial part now. Okay, you take a loan or you take an investment, you pay the coupons, pay the premium. That's one part of it. Has the covenant quality, become more, I would say, robust in the last 5 years? And the technical defaults in terms of the non-financial deliverables by investing company. Okay. They being stronger, have they become stronger in the last 5 years, or you guys have become a little more relaxed into that? As long as money keeps coming back, technical defaults we can be overlooked to a certain extent. This is an uncomfortable question, so anybody can answer, starting with Ashutosh.
For a credit analyst, covenants are what horoscopes are for astrologers. All of us are looking for imminent doom, and we are searching through them. So for us, when we look at covenants, when we look at what the structure is, our only worry is that what happens when shit hits the roof. Will we be able to take out our money? There are some covenants which are, let's just put it this way, that when we go to a promoter, we want to take a maximalist stance, ask for everything, and then we also know in our mind that what are the things which we can let go and which don't meaningfully worsen the trade. When it comes to competition, when it comes to negotiation, those things are typically up for grabs, that whoever gets them. But when it comes to the critical ones, whether it's payments, whether it's security jeopardy, whether it's cross defaults, whether it's IBC, all those, in some cases, for example, you will have a hotel, then approvals, permissions. So whatever is critical is always like ironclad. There'll be absolutely no change there. Whatever is non-critical, maybe you could give something here, something there, but it doesn't really matter. Largely speaking, as I said, competition is left behind at the door when the promoter decides to engage with somebody. And after that, it's just simple negotiation between 2 counterparties.
It's more like a relationship-driven kind of
relationship, and somebody has to run the business. You can't have a situation where covenant, for example, tomorrow if I go to, let's say, a working capital heavy business and say that your debt to EBITDA is 2 times or whatever that number is. But if he has to borrow money from banks, you have to give him flexibility that if the business grows, it can't be bad for me, and therefore I have to give him that allowance. So it's a give and take, but largely speaking, our thought process is that whatever is critical, whatever ensures alignment and whatever ensures proper behavior is well protected. That's where
understood. I'll quickly
to just add to that. I think that's a good point, but effectively when you structure a transaction, at the end of the day, those covenants and everything kind of lay down a roadmap where the company is committing certain things to you. You as a investor are kind of forming a view, and there will be certainly a gap between what the company is committing as to what you think needs to happen at the bare minimum. And within that scope and within that space, there are certain give and take that can happen at a point in time. But also I think it is a very important asset management tool, because ultimately these are high touch, high operative intensity investments. So it's not like typically lending is, okay, you've given the money and you hope that the interest and the principal is just coming back. But in all these kind of things, you are actually with the promoter, with the company all the time. So to that extent, I think governance, apart from just whether it is a default or not a default, actually is a very important ongoing asset management tool in terms of having a continuous discussion with the company as to this was your promises. Why is it moving around? It doesn't matter because the company doesn't really know what we have underwritten. They certainly know we have some buffers, but which buffers are important, which are not. So I think it's, so I don't think at least we don't think of governance lightly. When we go in, we know that every covenant movement we will not gonna kind of call a default, but I think many covenants will actually initiate an important discussion.
Just to add my perspective on covenants. Putting covenants is standard. You will have to do that because you have to put those guardrails around the credit, right? So that's a standard strategy. Everybody follows in some shape and form, right? But what is bespoke when it comes to risk management is how you act on those covenants, right? You may have 10 covenants across all trades. Few of them will be in breach. Does it really necessitate for you to take any action? So that's where the risk management strategy actually comes up. That what's your response to those covenants? I think that's defined everybody's different risk management strategy.
Understood. Okay, now I'll quickly go to Apurva. So Apurva, venture debt now sits in a very, I would say, tricky spot. Okay, you essentially are looking at performing credit, but also to the companies which are pre-profit or they are yet to establish a very strong balance sheet by themselves. Okay, so how do you decide on debt when there is no DSRA? When I say DSRA, it's debt service coverage. So how do you decide on that?
So it's a mix of many things, and I would say 25-30% of our companies are profitable. Yes, a good chunk are not profitable at an EBITDA level, but whichever company we invest in is positive at a contribution margin level. Essentially, we try to ensure that the company has reached product market fit where it's generating enough in terms of their pricing revenue to cover for all direct costs, which is COGS, shipping, collection, packaging, warehousing, customer acquisition, any kind of logistics. So you are covering all your direct cost and semi-variable cost. The only reason you haven't achieved EBITDA profitability is you haven't achieved the scale to take care of your fixed cost overhead. That's the guiding principle for us. Second, of course, is the company should be a category leader in its industry. So it has to be the number 1 or number 2 player. Rarely do we go to a 3rd or 4th player because consolidation happens almost in every industry. The third very important factor for us is leverage is always controlled. Like debt as a percentage of whatever equity capital they have raised should be less than 15%. As a percentage of valuation is say less than 5-7%. That gives us enough headroom that even if something has to go south, you have enough buffer and enough skin in the game from the promoter, existing shareholders, that for such a small amount of debt, you are not going to let the lender take control and drive whatever action they want. So, and we only come in after the company has raised substantial amount of equity from a good, reputed private equity or VC investor. So it's a mix of all those things. So yes, it can't be very objective with respect to meeting certain ratios, but it's a lot of other things, whether we feel this company is sufficiently well placed to raise the next round, and our debt repayment does not depend on the company's ability to raise the next round. I think it's a conception that most people have. But because we are coming into the company with a certain amount of comfort on the current amount of cash sitting in the balance sheet, the liquidity, the liquid nature of the kind of current assets that the company has, many of these companies have that, and that's why you'll see consumer as a big portfolio for all venture debt funds. Because end of the day, we are also doing back of the math on why you're using the debt, right? There has to be a substantial asset getting created on your balance sheet. Yes, there's a tail end risk of say 3 to 4 months that we are underwriting that the company should be able to raise the next round of equity, given the unit economics are fine, it's a category leader, the company is growing well, backed by good sound investors, and overall the feedback of the promoter and the KMP level is good.
So 3 key words I picked out from what you said. One is scale, second is buffer, and third is no refinance. Okay. So essentially, in your portfolio, you'll be having companies requesting you for that extension because there is going to be a likely default in the next 6 months, where you thought the cash flow position will be is not there, and your repayments are coming up. Okay, so what is the general thing that you follow? Okay, in such cases, are extensions rampant, or instead of what you follow, what has been your experience in the last, say, 24 months?
So one thing is, you'll never see venture debt players refinancing each other. It does not happen. I mean, we'll never give a company debt to refinance the other player. It's not a question. When it comes to extension, yes, we have been supportive, and people have to be supportive because it's an ecosystem where you have to, you can't be very knee-jerk with your covenants, right? That when it happens with banks, there's a covenant breach for 2 days, and then they can stop the cash flow, sweep out, put a debit freeze, whatever. So this is an industry where you need certain nuanced relationship. You can't take very knee-jerk reactions. You have to understand that every business goes through ups and downs. You have to understand whether it's temporary or more long-term or permanent. So if, for example, there's a covenant breach which you have a good visibility that in the next month and a half, it will get sorted out, it's fine. But when you see that, the equity shareholders are also not aligned, and you see certain gaps where you think it's more long-term, which is when and as Ashish had also mentioned, it's a very good negotiation tool that you come across the table and we'll discuss what can be done. In my experience in the last 7-8 years that we've been lending in this ecosystem, about 10% of whatever we invest in can demand some amount of, say, breather in covenants or certain extension of 2-3 months, and less than 1.5% where such extension, or I would say, such stress could be more permanent in nature. So it's actually, because we are in and out very soon, our tenor also, like Ashutosh said, 18-24 months, we don't exceed that. So when we are underwriting or entering a company, there's a lot of visibility on how this will pan out to be, because we are not there for a very long tenor. Our underwriting is, it's very visible on what can, cause trouble, say, 12 months down the line.
So essentially, your venture debt will not be refinanced by another venture debt. It will be taken over by a growth debt or a growth capital. Okay, so where does the boundary lie? I mean, your venture capital, now growth capital, typically if at all I can talk about a series A vis-a-vis a series C. Here I would like Gurudat also to come in, that where does the boundary lies, and because the boundaries are blurring, do you find some pressure in terms of pricing?
So yes, there is overlap when it comes to late stage companies. We have a lot of pre-IPO companies. Many of our companies are now even listed, and in a bulk of those companies, obviously there are multiple lenders on the balance sheet. We share space with other performing credit players, with banks, with NBFCs, multiple of them. The pressure comes on warrants, that because venture debt as an asset class has a combination of coupon as well as warrants that we take in our portfolio companies. More late stage companies will not give you warrants, or will give you a lesser warrant percentage. So the pressure comes on that. I think pricing wise, because everybody here wants that mid-teen net return at least, we have not seen pricing being compressed as much. But yes, the expectation of not having warrants or reducing warrants is definitely there.
Guru, your perspective?
I think when it comes to the transition from venture debt to any form of performing credit and thereafter, I don't think any of the fund managers would want to quickly jump the moment they think there is a transition happening from being a venture debt-led company to a company that can be funded through other forms of credit, performing credit to start with. It is important to first see whether the profitability has been sustainable or not. So, it's not like you have 1 year of PAT and then, the company is out of the woods. So, it needs a little bit of consistency, I guess. Secondly, it also depends on the scale of the business, because it depends on what the mandate of the fund is and what kind of companies you want to onboard. So scale of the company makes a lot of difference. The sustainability of the margins and the generation of cash flows needs to make a difference. I think that is the time when one could potentially explore. And obviously, if things have improved, it is fair to offer an IRR which is better than what they would have been paying to venture debt. But that's a part of the game. But I don't think that should be a maddening rush to onboard a company till some of the basic concepts of credit investing has not been fulfilled. It is better to wait and watch rather than explore something like that.
Thanks. Going over to Anshul. Anshul, given the very bespoke kind of investments that you do, okay, and these promoters are different from each other, the industry in which they operate are different from each other, the pricing time, environment is different. What is your pricing strategy? Okay.
Yeah, so I think frankly speaking, and I'm sure many people will agree that in the category that we are playing, which is high yield, right? In fact, mid yield to high yield, right? Whatever we call it. I think its pricing is completely black box. Okay, and I'll tell you why. See, when you start with your triple A's and double A's of the world, right? The pricing is very simple because there are only three factors in my opinion, which is rating, tenor, and maybe the nature of the instrument, which is secure and unsecured. So you can think in a three-dimensional space, and you can probably have a very range-bound answer in terms of the pricing. But when you come down to mid-market segment, which are maybe triple B's and A's of the world, there, and you add the complexity of the bespoke structure, right? It can be holdco, opco, there can be seniority, subordination. There can be several other structures and terms in the term sheet, which gives you like a multi-variable sort of a setup, right? Now, unless everybody in the market is Stephen Hawking who can think in 11 dimensions, there is no way the pricing will become scientific, right? And therefore, you will have some gut feeling in terms of what range it should be priced, but you will never be very scientific about it. And you add the complexity of instruments now, right? There are people who will do NCDs and CCDs and OCDs and all those combinations. So it's again a layer of complexity over that. And then today in the market, the pricing is also getting determined by liquidity or supply demand, right? Relationships. It's also getting subsidized by some other, cross revenue for the firm. So all of these factors are also there. It might not be really completely related with the credit you're talking about, but all of these factors are still there. I mean, we can't really deny all of that. So today, I think, there is no science to it. Everybody is playing so that, in terms of intuition, in terms of where it should be rightly priced. If it fits my strategy as well, it fits my yield expectation as well. If all of that is happening, you're good to go. And negotiations, of course, that's also a big part in terms of what's happening between borrower and the lender.
Okay, again, two keywords. One is high yield, second is expectations. And expectations of yours and expectations of the promoter or the investing company. Given that your high yield is much higher as compared to the traditional, debt instruments or whatever, how do you manage expectations? How do you manage expectations of the promoter?
Yeah. No, I think that, my sense is that was an issue when we started off, right? 10, 11 years back. I think it was difficult for us to make them understand what's the, why we are pricing this at what it is and what's the value add. I think over the course of years, they've become, much aware in terms of this asset class and what it can do. Today, they understand that this is more like an equity minus product than a debt plus. So, and there are examples, right? Now in last 10 years, there are examples to showcase in terms of how this capital has helped entrepreneurs and promoters create a huge stakeholder value. So I think today it has become much easier in terms of managing their expectation. We do not face many situations where we have to really explain why this is getting priced at what level it is. So it has become much better in last 10 years, I would say that.
With the expectation of the promoters comes your expectation of downside protection. Okay. So number one, that there are various security cover, cash flow, waterfall, okay, promoters guarantees, okay, corporate guarantees. So while you price a deal, okay, what is the balance that you maintain for pricing of risk? Or again, is it bespoke? I'm sure it will be like, but is there any formula that you have as your organization?
Yeah. I think downside protection will definitely come before pricing, okay? Because there will be certain risk and structure which I wouldn't really do whatever be the pricing, right? So downside protection is the key to it, and then once the structure is comfortable for you to really put in, then you talk about the pricing bit of it, right? Now downside protection has two aspects. One is from a value standpoint, right? Now, as I told you, this is more, this is one category where you do not have uncorrelated security to enjoy. I mean, we don't enjoy land parcels and fixed assets, etc., right? Which are uncorrelated with the business, which means that the entire underwriting has to happen on the business value, right? So you have to be absolutely sure in terms of what the quality of the business is, what the sector is all about, what are the headwinds, tailwinds, etc. Then so that you can ascertain a fair value to the business, because the first downside protection for you to enjoy is the LTV, right? What is the total value of the business against which what is your debt? That is the first safety net, right? The other downside protection comes with the structure, which has nothing to do with in terms of how the business is, but what are the things and nuances you have put up in this structure so that you have some safety net built out of it. That is where you have maybe the escrows and cash flows and promoter guarantee for the alignment and corporate guarantee for some other entities, all of that. So these are the two main, I would say, the aspects in terms of downside protection. Once this is done and you are comfortable, then comes the pricing. It's not a balance always, I'm saying.
Okay, moving to Guru now. Okay, Guru, multiples is essentially what I used to know was a private equity house. Okay, so your specialization used to be on the equity side. Okay, now forming credit strategy on the side of equity. Okay, what are the kind of pricing differentiations that you can see over here, and is a proposal sometimes tipping into each other as far as equity vis-a-vis credit? Okay, and at the end of the day, are you getting better pricing for your credit deals for your PE relationships?
Firstly, multiple continues to be a very important player in the private equity space. So having said that, I think as I had mentioned earlier, we really believe in the growth of the private credit asset class and the promise that it holds for all of us here in the room. Building a private credit strategy next to a high performing private equity franchise has been a very conscious choice. And the fact that we want to operate on the conservative side of the yield spectrum, and the fact that we think we can mobilize capital to deliver on the private credit aspect is something which we feel very confident of. But having said that, having a private equity franchise which is so successful and so formidable in India has obviously helped us a lot in terms of the private credit. I mean, on two counts. Firstly, the deep sectoral expertise that they bring, and secondly, the build out of very strong and long-term relationships that has happened over the years with companies, promoters, and similar other stakeholders. So it just opens a very different avenue for origination and prospective deals that you could do in the future. But at the same time, I would also want to bring out that, first of all, I don't think there is a correlation between a private equity originated lead for us and how we want to price it. I think the pricing is purely based on the independent evaluation of the transaction, the business, and the risk returns that comes with it. So I think there is no correlation there. But what the private equity franchise obviously helps us do is gets us access to potential companies that we could look in the future. So I think that's a great outcome for us. But more importantly here, I would want to call out that for us the bright line test is that private equity and private credit will not be invested in the same company, because we do not see that to be a fair approach. This is a commitment that we have given to all our stakeholders, so we will stand by that. But yes, there is always a continuous interchange of information. Wherever we need to do seamless handoffs, we do that. We try and ensure that potential businesses or potential opportunities are not lost. But at the same time, we are very conscious of protecting the integrity of our mandate, and that's how we want to take it forward.
So then when you talk about not investing in the same company, I understand, but as a strategy, you have a pool of capital that you would like to invest. You have I would say, returns in your mind that you have committed to yourselves. Okay. Now, is NCDs or debt a second sleeve for a private equity house, or there are clear distinctions that this is what this is what this is, and or is this blurring?
No, so I think, first of all, I disagree with the fact that credit is a second sleeve to a private equity house. I think globally, if you see several of the multi-product alternate asset managers, their credit arms have surpassed their private equity businesses. So I would rather say it is more appropriate to say that it is adapting to changing times rather than saying that credit is second sleeve to private equity or vice versa. So having said that, I think for us the fundamental of the deal matters more, which means, as I said, the business, the risk returns are more important than the investment instrument nomenclature. So you call it an NCD, CCD, CCPS, you can, but what is more important is what is the underlying deal all about. And the fact that we want to play in the larger deal space, we want to be conservative. We are not actually aiming to, or rather offering structures where we aim to provide supernormal returns or try and mimic what equity typically does, right? So we're not going to do that. Our goal is very simple. Just stick to the fact that you get an exit from each trade the way you've underwritten it, along with the desired economics that it needs. We will continue to be selective about picking up certain situations where we may want to do equity-like instruments. But again, that is not compromising on the basic tenets of credit investing. For us, the path to exit has to be unequivocally clear, has to be contractual, and all of this reflects in the returns that the fund is going to offer or is going to aim to offer to the investor. So from that perspective, I think we're very clear. And again, just to repeat, the private credit strategy is a very well-defined, distinct strategy within the institution. There are no blurring of lines. It is, it's run by a team which is fully empowered, which has many years of experience of having done that. So it is being accorded the importance that it deserves.
Bringing in my previous interaction with Anshul about managing expectations, okay. Can you give us a case study, because it surely happens with the fund houses who are also into credit, that one particular proposal which comes your way, and then you find that okay, maybe credit is not the right strategy for this. This guy actually needs equity, but since he is not understanding that he needs equity, he is asking for credit. Okay, so have you ever faced this kind of a dilemma, and if at all you can share? Of course, you don't have to cite names.
Yeah, it happens. It happens. I think the good part is that increasingly promoters and management have started to appreciate that private credit is a good alternate capital to equity, and this is both private equity as well as public markets. So there are different types of companies at different journeys. A company which is not yet ready for public markets would obviously want private equity. They do go with the desire of getting private equity, but each private equity house has its own mandate and they have their own investment parameters, and there are, more often than not, there are situations where it does not fit the bill of private equity. Now for us, because there is a internal conflict check mechanism, there is a mechanism to share information to see that if something which the PE guys can't do, can the private guys pick it up. That's an ongoing process, and we do that all the time. And there have been situations where a deal has come to us because private equity didn't fit the private equity mandate, and great business model, generating cash flows, ticks all it, as you may call it, is a great option, and I think it works well both for the investor as well as for the companies.
Thanks. Moving to Ashish. So Ashish, you have actually built Certus in the performing as well as special opportunistic space as far as real estate is concerned. So I would say that you are actually present in the mid spectrum as well as to the extreme end of the spectrum, okay? And now we are talking about, say, returns of, say, 15%, 14, 15% to 20% plus. Okay. So how do you look at the risk reward of, having this kind of a strategy, and about your
We're operating in, I mean, everybody is very focused on return and the predictability of that return. Because like equity, I mean, there could be a lot more volatility in the return, and there will be certain, star performance which will kind of take care of certain laggards. But in private credit, I think you're really looking at making sure every deal really performs, right? But each of us may have a slightly different. We are very asset focused. Now that asset has a finite value, right? And I think that value may change a little bit, but broadly that change is broadly inflation linked, unless there is some kind of a major change that's happening, which we don't want to in fact underwrite. So for us, what's important really is that there is cash flow and there is security. But I think one myth I would really like to dispel, many a times it is seen that higher return means higher risk. And I think that's really where a certain amount of expertise comes into play. So for example, real estate, I think trying to understand a real estate company versus a pharmaceutical company, understanding a real estate company is actually very easy. So much square feet, so much sale price, everybody has a view on the sale price, everybody has a view on the construction cost, everybody can do the Excel. On the other hand, a pharmaceutical company, I mean, you can keep trying to analyze, unless you are an expert, you will not get anything out of it, right? So because of that, there are a lot of people who end up doing a misstep. Now the devil lies in the detail. I can tell you every micro market of Mumbai will have a different nuance when it comes to real estate. Forget the cities. And that's where I think a lot of things have gone bad. In fact, while private credit has been more of an asset class which is in the discussion over the last 4-5 years, real estate private credit has been going on for the last 15-17 years. Right? So what I am doing today is actually the same thing I am doing for the last 15 years. Right? It is just that the liability side of it is changing, the acceptability is changing. So the thing with us is we take longer durations because we match asset cycle with the liability cycle, right? There is a large amount of capital of real estate that cannot be financed by traditional lenders, and therefore I think the format that remains consistent is people need a solution for a shorter period of time. While we may give a longer duration, 99% what we have seen is we get refinanced in 18 to 24 months. But we never underwrite refinancing. That's a perfect example why a lot of projects and people got stuck, because when ILFS happened, refinancing market shut down overnight. And if your asset and liabilities are matched, then that kind of works, right? So I think, one is, but also, and this is going to Anshul's point earlier, even our business is very driven by a solution and both counterparties getting comfortable with each other. Especially in our business, we control every rupee of cash flow. Every single receipt, whether it is provided by a bank, whether it is our own funding, or whether it is a sale of the underlying, comes into an escrow account that is controlled by us. And at the end of the month, the guy has to come back to us to even pay his salaries. So the borrowers also want to be very comfortable that as a business we are mature, we understand what we are doing. Otherwise, we can really disrupt their business by our own follies. Right? So I think so that therefore the small difference in the return doesn't really make much of a difference. The other bit, which is, this is really the performing credit. So where I think on the performing real estate credit, we can easily do mid to high teens. But the other bit, and as Certus started, it kind of, it is about 8 years back, it kind of perfectly coincided with ILFS crisis. So not that we were designing to be a special situation player, but just the situation just became special in the credit markets in the country, right? And there was a point where actually and why I was saying at the beginning, distress versus special situations, in our mind we just define them differently. Many times distress is actually associated with a true turnaround. A plant, a project, a certain counterparty is just not doing well, and now you need to go in, you have to turn around that. On the other hand, think of a special situation is a shop which is on fire. Now the goods within that shop might be fine. And if you can act fast, go into that shop, get the best pick, you might get it at a 30-40% discount. And that to my mind is a little bit more of a special situation, and we did a lot of that in the beginning. Where for perfectly performing credits, which may have otherwise been priced at 12-13%, got sold for 20%.
So Ashish, I am aware of assets and transactions. Okay, I will definitely not name the asset or the promoter, but there was a asset which was invested into by a PE fund, which gone bad. Okay, then it was sold in the market as a distressed asset, as a proceeding of an NCLT. Another person came and acquired that particular asset. Okay, of course at a kind of discount that you're talking about, and I think you funded that acquisition. Right. Okay, so when you're looking at this kind of other end of the spectrum, distressed assets acquisition funding, then what are the parameters that you look at? I'm saying this because of two reasons. Number one, I am into acquisition of distressed assets, and number two, I would like to bust the myth that going for this kind of an acquisition financing is not cowboyish theory. There is a method in the madness to it.
Right. No, I think that's a very interesting example, and it's not exactly what I was describing, but I'll give both examples, right? So this particular situation, so now there is a private equity fund that made an investment that went bad. Because it went bad, the private equity fund actually took all the procedure and they took the company to NCLT, actually acquired the asset. Now what happened? Now while the private equity fund has acquired the asset, they are not in a position to operate it, so they needed an operator. So they actually infused an operator, and the operator did a very good job of actually taking that asset. I mean, it was a real estate asset, so it was a project which just stuck. They took it from that point in time to when we entered, it was already fully approved, RARA compliant, and 50% sold. So to be very honest, the underlying asset has no distress at all now. But this private equity fund has already run to its end of the tenure, and they were therefore now wanting to exit as opposed to wait for that whole project to get completed. So our approach to this was, there was complexity in making that transfer happen, right? There was an NCLT history, so no traditional bank finance will come into this thing. On the other hand, the underlying asset is fully performing. So we financed the development manager to acquire that asset from the private equity investor. And in that process, we made more than 25% return on a project underlying a project or an underlying risk which is already performing. So I think that is like a bit of a thing which is a combination of actually relationships in the market. If you have been around long enough, you probably know the development manager, you probably know the private equity investor, right? And you also know that the legal complexity that you will have to go through. In a similar context, I will give you another example. I mean, this is when we just started Certus Capital. Now, certainly ILFS default has happened. Now, all lenders at that point in time, like for the first time in my life, I actually looked at my debt mutual fund portfolio, starting to look at who are the lenders in that portfolio, right? And the point was, a lot of AAA companies was very quickly coming into stress. So they needed to actually at that point in time, if your normal lending markets have shut down, you need to find an alternative way. Now think of it, the typical, so if you look at not a bank but a NBFC or a housing finance company, they're very used to securitizing retail loans. There is a very large market that has existed then, that existed now. But then a lot of these companies were stuck with a lot of large real estate loans. And some of those real estate loans at a single exposure level were 1,000 crore and upwards. So we looked at a situation where we received a book of 11,000 crores. And the guy wanted to just sell that entire 11,000 crores lock, stock and barrel. But when we looked at it, India has not evolved at that point in time, at least as a market. We picked up two assets. Now one of that asset was a 1,700 crore asset given to a 60,000 crore conglomerate, running 12% return, right? So again, absolutely nothing wrong. The underlying projects were near OC. But just because of that market situation, that lender which owned that loan sold that for more than 20%. And we basically used securitization regs for the first time in the country to actually sell down a wholesale real estate loan. So I think a lot of our business is a function of knowing the underlying well, but then how can you really navigate the regulatory landscape? But a lot of these things require very fast action because they're very time-based. 6 months, 9 months later, the situation will change.
So in the interest of time, I would like to wrap up this session by asking two questions to everybody, okay, all the participants. Number one, is the tiger's territory being encroached upon by the panther? That is, are you tipping into each other's territory? Okay, number one. And number two, what is one fundamental risk in your mind that Indian private credit, spectrum is still ignoring? It is yet to be incorporated as far as your, more than 2 decades of experience goes in your respective fields. Okay, I'll start with Anshul.
No, so very simple answer to your first one. Of course, we are rubbing shoulders with our adjacencies, and that's happening because it doesn't. There are two aspects, right? One is yield, right? Yield, of course, because as a fund manager, I have to just maintain that yield in an overall average way on a portfolio basis. So I can, of course, go one step here and one step on the downside. From a product standpoint, I don't think we are rubbing too much into each other's territory. I don't think I will probably do a distress or a special sits. I'll probably not do venture. So I have to still play largely in the performing credit category. So as far as product is concerned, we are still there within the realm of what we are supposed to. But yield, of course, we can manage to really go here and there.
And that risk, which you think is, should be there, but
yeah,
we are overlooking that risk.
I think if I were to really put one risk out there, I would feel it will be concentration of refinancing. Okay, we may underwrite with, and in this category we underwrite a lot of liquidity events, which is PE, raise, IPO, asset sale, etc. Those, the entire equity cycle is, it's a long cycle. So you may have a big dry spell where you do not really get any of these liquidity events, which basically means that on the back of the envelope or the, as a fallback, you always have refinancing as one of the fallback option. Now in last 2-3 years, everybody is, has a lot of capital to deploy. We all are deploying into assets. These are, as Ashutosh and other guys mentioned, these are again 2-3 years sort of a paper, right? So you will have from here on every year a bunch of concentration in terms of refinancing. And tomorrow, if the liquidity in the entire asset class does not support, if there is no fresh capital coming in private credit, which we have not seen so far, it's an asset which is now abundantly having supply. But if there is a period where the supply goes bad or goes down, and you have a concentration of refinancing, that is something I don't think many people are underwriting or thinking about it.
Guru?
So I think there is enough and more for each of the strategies that we have spoken about to do in this country. So it's not like there is a dearth of venture debt opportunities or there's a dearth of special sit and opportunistic trade. So the need to blur lines and try and tip into some other's territory, I don't see the need for it as long as you're doing justice to your own mandate. So, and it's very important because, Shubha, you also mentioned about blurring the lines. We should not forget that the LPs are very clear as to what they want their managers to do, right? So private credit LPs do not, they like a predictable risk return, adjusted return, IRRs. They do not want any equity risk volatility and so on and so forth. So if you are blurring lines, it is very difficult for you to explain your own risk reward hypothesis to the external market. So I think that's not a great idea. It also violates the mandate you've been given. I think the blurring of the lines and tiptoeing into each other's thing is not a requirement. I don't think there's a need to do so. The risk that I foresee, that's a good point which Anshul made about refinancing punching up. I have 2 points to say. One, I'm always wary about mispricing of credit. So where there is crowding out that is going to happen on a particular undifferentiated strategy, there is this risk of mispricing. There is the risk of moving from a covenant right structure to a covenant light structure, right? So these are very inherent things that one should stay away from. The fund managers that I know in this country have very deep expertise of running their own businesses. They understand the nuance. So we are in good hands. But this is something, there's no systemic risk in this asset class, in this industry, but this is one thing we should be aware of. The second thing which I feel is that we've gone through a reasonably benign credit climate over the last couple of years. Everything is looking good. NPAs are low and so on and so forth. So all those nice tailwinds. Now, with the geopolitical situation changing and resurfacing every now and then, there will be a time when the tide is going to turn. So at that point in time, how does your portfolio hold up? All those covenants and EWS and trackers that we just spoke about and we've been chanting through,
Stress
are they
test.
good enough to
Stress
sustain?
test is the word.
Yeah.
Stress test.
Are they going to sustain and hold up? I think that's going to be a very, very interesting thing to watch. And finally, if it comes to a situation, how does IBC help you do this? Because we haven't seen too much of private credit go into IBC. We've seen banks go into IBC a lot more, or NBFCs. But how does private credit deal with IBC? Something which will be critical to watch. I think these would be my high points that we should look out for.
I'll take 20 seconds more. Okay. I wish I could extend this session by 1 more hour because there are so many questions that I would really like to have answers from this eminent, panelists over here. But let's take an audience poll now. Okay. On the basis of the interaction over the last, say, 45 minutes, how do you categorize private credit? Growth capital or problem solving capital? Okay. How many for growth capital? Can I have a raise of hands? You also.
It's capital.
Okay. How
Capital
many has
is
problem
fungible.
solving capital? How many has problem solving capital? Well, I think it's a tie. Okay. Let's see if the tie breaks in the next session or next kind of gathering that we have. But thank you so much.
Thank you so much.